Lululemon stock is down about 50% year to date, as the stock peaked out just over $515 on December 29th of last year. Even though Lululemon is not a stranger to large drawdowns, there are some decent challenges to the business. About 6 main ones in my opinion. Let's break these down in detail with the use of data and comments from different companies. And we will also look at the company's recent financial performance and see what the company needs to report, in my opinion, to start climbing back and return towards a widely appreciated stock by Wall Street. So let's start off with the first problem, in my opinion, and that's the widely reported pressure on the US consumer. Now we know that the inflation rate has been high in recent years. This is of course the reason why we have the entire situation with a looming recession or not. And, well, like I said, the consumer reportedly being under pressure. And we also know, just thinking logically, that this must be true. But to what extent? Now, we can see in the data here that the US retail sales, and this is a month-over-month figure, has been ebbing around that flat mark. Now, we don't expect this to be up 1% every month. That would be a bit much. However, we do want to see this number being up more often than not, of course. Now, with the latest figure we got, and this was last week, we saw an increase of 1% in retail sales on a month-over-month number. And what we see in that chart is that this has been the largest uptick, basically since around January last year. So that's very positive. And there are reasons, of course, why this happened. And it can, in my opinion, be maybe too basic, but very simply explained. And that's that we see the inflation rate. Now, we have the CPI year-over-year number, and we can see the immense peak we had in 2022 and 2023. But right now, the year-over-year CPI number is 2.9. Now, there's a lot of discussion if this is an accurate number. That's not what we are going into right now. But what we can say is that this has been trending down. And if we look at the month-over-month inflation rate, we can see that this is now at 0.2. Last month even being negative. Now that negative read was the first one basically since the pandemic. And although negative inflation isn't positive, if we combine it with the average hourly earnings and the increases there, we can see that this is about steady at 0.2. So if we have an inflation rate of minus 0.1% month over month, but we have average hourly wages increasing by 0.2%, then we get an increase in spending, of course, or possible spending. Consumers are catching up with their real wages. Now, in my opinion, this is what contributed to the bounce back in the retail sales on a year-over-year number, because that was 2.7% in the latest reading. And ever since March, it has been trending down. The last couple of reads were down and down and down. So to have an uptick again, that's very positive, of course. Now, not only the US consumer is under pressure. It is widely reported that the Chinese consumer is also under pressure. It's depending a bit per quarter, even per week sometimes, because the numbers we are seeing or the reports we are seeing are very variable. But if we look at at earnings reports from different companies, we can take a bit of a tell in there. And I've highlighted a few that I find a bit similar to China or to Lululemon. But let's first look at their own earnings report, because how important is China actually for Lululemon? Now, what we can see on the net revenues, and this is from their latest earnings report, we can see that revenues for the United States consist of 73.44% of total revenues. China mainland consisted of 13.75% and the rest of the world for 12.81% of total revenues. If we then look at the operating income, we can see that the Americas consisted for 75.18% of total operating income and China mainland for 15.94% of total operating income, with the rest of the world at 8.88%. So the rest of the world has immensely lower margins than China and the US. However, when we look at the Americas, we can see that their operating margin or their income from operations has a lower margin than last year. It has been ticking down a bit, however, it is now at 34.82%. In China mainland, it has been going up. So there's a bit of a disparity there. But at China mainland, it is now at 39.43%. That is a really high margin. Even in the Americas, it's high already, but China mainland, 39% operating margin. That's extremely high. So that's also very positive, but it also highlights how important China is, well, for the growth story of Lululemon. In their last earnings release, Lululemon also highlighted how they had on a constant currency basis 52% revenue growth in China. That's an incredible amount of growth. And if we look at the comments that were made there, we can see that Megan Frank, the CFO, commented that from a China standpoint, we are very pleased with our business in that market. We continue to see very strong trends in Q1, so plus 52% constant currency China mainland. I would say from a competitive landscape, we continue to see strong business on our side. Definitely closely monitoring that environment, but we are really still early in our growth journey there, and no concerns at this point in time. So in the latest earnings call, there were very positive comments about China, and as we can see, that's also quite important with that margin and with the growth the company is seeing there, because the United States or the Americas business, that only grew fractional. So most of the growth right now is coming from China. So the sooner it can get to a real meaningful, well, growth number or revenue number, the better it is for Lululemon at this point. But then I also want to, well, highlight about 5 different consumer-facing brands that are also in China, of which 3 of them are seeing quite negative things and 2 of them being positive, because I think it's good to, well, to see the differences there. And the first is Starbucks, a company I made my last video about why I bought into Starbucks. But they saw a negative 14% comp growth in China. So we know that Starbucks isn't really doing particularly well in China. Another company that isn't doing all too great is Nike. And Nike said even in their last earnings call, we've softened our outlook for Greater China. So they are even lowering their guide. That's not quite positive. I think I don't really have to say that. But it's not good. Lastly, we have Apple. Because Apple, although it's much more premium and a much higher ticket item than Lululemon, the question here was raised by Eric Woodring, an analyst. Can you maybe dig into the China dynamics on a bit? Because the sales are down 6% this quarter. And Tim Cook, the CEO of Apple, said we've decreased by 6.5% year over year for the whole of Greater China. And if you look at it on a constant currency basis, we declined by less than 3%. Because I think it's also, 6.5% sounds way more dramatic than 3%. But still, Apple is seeing a slowdown in China. Now, this is not from the latest quarter. This has been happening for a bit of time already. But we know that Apple is also seeing a slowdown there. So then, what companies are seeing a pickup in China? Because I also want to highlight 2 very consumer-facing companies. Now we know that Deckers, they say that the growth was most meaningful in China. So what does Deckers own? Now Deckers is the company behind Uggs and Hoka, for example. Hoka the running shoes and Uggs the quite ugly but very warm and comfortable shoes or boots. Now another company that is seeing quite positive feedback from China is On Running. They say on a constant currency basis, the growth was even higher at 84.7% from the continued strong momentum in China. Now, this was for the entire region, for the Asia Pacific region, but they highlight China as their strongest market. Why did I choose to look at On Running and Deckers? Well, they're in the shoe business. And Lululemon is somewhat in the shoe business as well. They sell shoes, of course, but they also sell lifestyle stuff, the athleisure segment. So a bit of the conclusion I draw from it is that the newer, hipper brands are doing really well. Not saying that Apple isn't a hip brand, but doing 2 years or 3 years with a phone is quite well doable, especially if you're a bit, well, easygoing on it. And the new running shoes or the lifestyle brands in Dex Outdoor, that's of course a new and trendy thing, or they are really expanding in that market. And they are upcomers in that market. Now, we are also seeing good momentum with Lululemon in China, even though they are there already for 10 years, 11 I think. So having the growth still going there is really positive, but I also think they have to be careful not to waste it. And maybe you have seen it in the slide I had at the beginning. But the third issue I think that Lululemon is facing right now is their products, because they had the breeze-through leggings taken off the shelves after negative comments from customers. So what I did was I went to the Lululemon website and I checked if the collection was still off the shelves. And well, you can see it. The collections for the leggings, there is no breeze-through there. It's the Align, the Wonder Train, Wonder Under. There are plenty of collections, but not the breeze-through leggings. So what happened? Well, Lululemon got a lot of comments and a lot of hate online for the leggings, saying that they give customers a long butt, for example. So what happened was that with the new fabrics and a new stitch method, instead of the front seam, they had a new V-shaped seam, I believe. Now, pulling one collection off the shelves, although it's not great, especially not when you get negative comments on the brand, it's only one collection that flopped. They have multiple new collections each year, and having this one thing flop isn't the end of the world, although it's not great. But what would be worse is to continue selling them and continually get brand damage. That's something Lululemon can't have right now. So to pull the items off the shelves really quick after launch, I think it's a smart move. It's a bit of damage control. Now, another thing they need to do damage control in is the inventories. Because while Lululemon is missing out on opportunities due to having a lack of inventories, they have products out of stock. And that's not really good, especially with competition increasing. Now, I will come back to that increased competition later on. But right now, what we can see is coming out of last quarter's earnings call, where they also admitted that they didn't have enough color or newness in their business. They said that they came into the year with some missed opportunity across all size profiles, particularly in their smaller sizes. And they also said that this will be addressed in the second half of the new year. And although I think it's good that it will be fixed, it should also be somewhat of a minor fix. Get more inventories, order more stock. And I understand that it's not done that easily, but they should really try and get that issue fixed as soon as possible, because you are missing out on consumers. And the competition is on your heels. Now, then there is the fifth issue, and that's the departure of Sun Chu. She has been named as pivotal or a driving force behind the success of Lululemon, because she really was the creative brain behind the brand. And although I like to believe that she is pivotal, I don't believe that a company that's worth 30 billion right now, with basically the lowest valuation it has ever had, should be dependent on one person. I simply don't believe so. That shouldn't be the case. There should be succession plans, there should be trainings, she should have guided the people behind her or beneath her in order to make sure that they're never in an issue or with a problem whenever she decides to leave. You can't be that dependent on one person. Besides, there's an entire team she's working with. So then lastly, we have the competition and the growth slowdown. Now, after this, I will explain what Lululemon has to do in order to become widely recognized as a compounder or a growth stock again by Wall Street. But first, the competition, because that's increasing a lot for Lululemon. The athleisure industry is growing. We know that's a fact, with more and more players. It's not just Lululemon. There are multiple businesses right now, and two of them are Alo Yoga and Furore. And what we have here is a snippet from an article that highlights just how bad the competition is. Now, this article is one of the headlines I showed previously. So that's good to know, the out of stock headline. But what they say is that about 90% of Fiori's US stores are located within 0.5 miles of Lululemon, while 84% of Alo stores are within that distance of Lululemon, according to Bernstein. The two brands each have gained about 1 percentage point of athletic apparel market share over the past year, while Lululemon roughly remained its shares, according to a recent BTIG report citing Earnest Analytics. So basically, what they are doing is trying to piggyback on the success of Lululemon. They're just placing their stores right next to Lululemon, in order that when you're going to Lululemon, you might just walk into their stores, check out their brand, check out their products. And that's very smart, of course. But it also creates the problem for Lululemon that when they are out of stock, well, the competition is just going to, well, them. The consumer is just going to the competitor. And that's not good. What they also say is that those two companies aren't so small that Lululemon can ignore them. Their combined women's US business has annual revenue of about 1.5 billion, representing about 38% of Lululemon's size in that market, according to Jeffries. And Gap Inc.'s Athletica, a large company that had been losing market share over the past 2 years, recently returned to growth. So we are really seeing that competitors are coming up. And this doesn't have to be an issue for Lululemon. They are still the main dominant player. They just can't sit back and enjoy the position they are in. They will have to keep fighting for their customers because they'll just go shop at the next door. So what about the growth slowdown we've been hearing about? Well, basically what we have here is statistics that shows the quarter-over-quarter growth of the trailing 12-month revenues. The LTM is what it says here. It's the trailing 12 months. And what we see is a, well, gradual downslope basically ever since the beginning of 2022. Now, what else do we have that confirms the slowdown? That's basically this chart. Well, we can see the EPS growth, or the projected EPS growth for the next 5 years. And that's now lower than we have seen it be in the last, well, 10 years, basically. And with the expectation of that just collapsing, we have seen the stock collapse as well. It's down 50% or about 50% year to date. That's just not good. Now, however, we do need to put this a bit into context, because what we see here is an historical figure, basically the growth Lululemon has been having over the last 10 years. And what we see is, what I try to highlight is, with the latest quarter or the last 12 months, what has been higher and what has been lower. Now in red is what has been lower, in green what has been higher. So what we see that is in 2015, 16, 17 and 18, revenue growth has been lower than it is right now. In 2019 and 2020 it has been higher, in 2021 it's been lower, but in the last 3 fiscal years it has been higher. So for the recent years we are seeing a downtick. However, historically speaking, 15% over the last 10 or the last 12 months isn't actually that bad. Now when we go down, we see the net income. Now the net income should go up, but the net income margin, it's been 13%, 12%, 12%. Wow, okay. It's been around 13% in 15, 16 and 17, then 9.7% in 2018, 14% in 2019, and it was 16.2% in 2020. Okay, but then for a part of the year, all stores were closed, so they were only selling online. Then we had 21, 22, and 23, fiscal 23. The net income margin was lower than it's been on the last 12 months. So the net income margin is still very high. That's not really given in here. Now the diluted EPS growth, that is also still extremely high when we compare it to the prior year. Now we know that if the revenue increases come down, then the EPS growth should come down as well. So of course that is having an impact here, and this number will go down later in the year. And fiscal 25 will not be as high as fiscal 24. But what we do need to look at here is the increased efficiency when we see at the cash flow analytics at the bottom. We see that in the last 12 months, the cash from operation is by far higher than it's ever been. So that will also be a good metric to look at, because this is of course all cash that Lululemon in the future can return to shareholders. Now here we see that revenue broken down a bit into quarters. And what I've circled is the fiscal 25, but Q1 revenue increases. And that was at 10.4%. So that is very much lower than the previous quarters we have seen. But with the upcoming dominance or the upcoming importance of China, I hope that this will change rather quickly. But that's remained to be seen. However, 10% is a notable slowdown from prior quarters, of course. Now, what else are we looking at here? What I've highlighted is the days outstanding of inventories. And right now, or in the latest quarter, that was 130. And that was already up from Q4 24 when it was 104.4. Now, obviously, this should increase a bit more because we have seen the out of stock issues. And if it shouldn't be increased a bit more, then it should be better spread out between products. Because these small sizes and color, they just simply need it. Because, well, customers will just go to competitors. Okay, so then is it all that bad? No, not really in my opinion, although it's not particularly great. It doesn't really have to become a problem. We see that stat again for the last 12-month quarter-over-quarter revenue growth. And that's at 2.16% now. And the average over the last 10 years was at 4.68%. However, if we look at the graph of the revenues, the trailing 12-month revenues, we can see just this beautiful chart that's just going up and up and up. But of course, it does, or it has had a boom after COVID. It has seen a meaningful increase. But with the slowdown in revenues and EPS growth, we can of course see a bit of a re-rating of the stock. And by a bit, I mean a lot. Like a lot. Because over the last 10 years, the average PE, the next 12-month PE, the forward PE, has been 35.9. Right now we are trading around 18. And that's bad. That's very low. I mean, Nike, that has been reported as having a lot of issues with their share price, and a very, well, in my opinion, a quite popular retail stock to invest in right now, that's still at 25. Lululemon is at 18, with more growth and a higher growth prospect in front of it. Now, this forward PE of around 18 for Lululemon is really not calculating any major growth ahead of it. And I think that's wrong, especially when we look at the China numbers. The growth we have seen in China, if they continue it, even at half the pace we are at right now, the PE should just go up again. The re-rating should be significant here, and the stock still has a lot of upside. Okay, so then what needs to happen, in my opinion? What should happen for Lululemon to be appreciated again by Wall Street? Well, first of all, the guide should go up. The analyst estimates for the stock need to be increased. But how are they going to do it? First of all, if we look at the expectations for Lululemon, we can see that analysts expect $2.4 billion in revenues. Now, if they come in at 2.47 billion, I think that's very positive, and we can see a jump in the stock. If they come in below 2.42 million or billion, that's an issue. And the same goes for the growth profit or the gross profit. If we see a number above 1.41, that's very good. If we see a number below, well, 1.395 billion, that's very bad. Continuing net income, if we see a number above 385 million, very good. A number below 375 million, not good. Now, why do I say the below number that should be above the analyst expectations? But that's simply because historically Lululemon has outperformed on this metric. So if all of a sudden they don't outperform, that raises questions. Now we have the EPS or the adjusted EPS, $2.95 expected. If they go over $3.05, that's good for the business. If they go below $2.95, that's bad. Okay, so then what am I expecting from this business? I think they can beat by a long margin. I also think the expectations are basically in the gutter. I think the pressure on the US consumer, that's going down a bit. I think the US consumer is going to a place where they can breathe again. Because the real wages should be increasing as long as the wage increases are outgrowing the inflation rate. Or at least not being as bad as they are. I think the consumer is getting kind of learning to live with having lower savings rates. And although that's not good, of course that's not good, it is something that is somewhat in my mind as possible. Now, the Chinese consumer seems to be picky at where they spend their money, because also when we look at Tesla or BYD, 1 month we see good numbers and there's hope for the Chinese consumer, and the other month there's not. Now, of course, this will just improve over the coming quarters, hopefully, but we are seeing that they are spending at Lululemon, and we are seeing that they are spending, a lot on running and Dex outdoor. So it's not like the situation is hopeless there. And that's also not in the numbers that Lululemon has been posting in the most recent quarters. But it's also good to see that from different brands. It's not a one-off for Lululemon. So that's positive. Now, the breathe-through legging flop, not great. I think they should not have brand damage at this point, because it's really something the stock can't really use. What they should also do, speaking about their brand, is increase the stock buybacks once again. In the latest quarter, they did a lot of stock buybacks. They upped the amount they can spend on stock buybacks. And I think they should do so again, because they should show that they value, or they know that the stock's undervalued. I think that's really important. They should signal strength to Wall Street. Now, the departure of Sun Chu, that shouldn't really be an issue. And I get it, it's a loss for the company, but there should be succession plans, especially for people that are that important or in such high ranks. Now, the competition, of course, is difficult to have stores that close to your own stores, but this is something all companies are working with. And if Lululemon is as good as they have been in recent years, they should be able to grow like recent years, or maybe at a slower pace, but they shouldn't have shrinking revenues. And in my opinion, that is a bit of fear that is currently in the market and somewhat being priced in here. A fear of a total collapse in revenue growth. And in my opinion, that's unjustified. We see the revenue growth in China is very big. And in the US business, it was still around 8%. Not optimal, but certainly better than an 18 forward PE. Now, let me know what you think in the comments below. Do you agree with me or not? And if you came this far in my video, please hit the subscribe button. I try to put a lot of effort in these videos. But thank you for watching, and I hope to see you in my next video.